Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friend Sam Clement. Sam, say hello.
John, how are you doing?
Sam, I'm doing fantastically. Thank you for asking. I got to tell you, though, here we are on Wednesday, June the 18th, 2025, in the afternoon. And really, with everything that's going on in the world, with obviously the situation with Israel and Iran taking the headlines in terms of global news, a lot of people that do what we do for a living on the investment side and what have you have been waiting for this day. And not because of anything Israel's doing with Iran, not because we had a G7 meeting or anything like that this week. Been waiting for it because it is the conclusion of the most recent Federal Open Market Committee meeting, which means, hey, we're going to find out what direction U.S. monetary policy is going to take. So Sam, the question is, did the Fed cut rates today?
Well, they didn't cut rates, and they weren't expected to cut rates, and they don't like surprising, so that in itself was not a surprise. But the Fed meetings have kind of felt like they've become what the inflation prints were. When they come out, you'd say this is the biggest one in a while,
Yeah.
and it seems like each Fed meeting we're saying, okay, this is the big one.
It's a big one. We're going to find, hey, everyone, bated breath,
We'll
all
get
that
some
stuff.
clarity on what the next 6-12 months looks like.
Yeah.
And that's what it's felt like each one. And then we've kind of, gotten what we expected and not a whole lot more than that. And so that seems to be where we're at. And that seems to be what this meeting was again. And not necessarily that people were saying it's the most important in years, but they're saying, well, this will finally open it up and give us clarity on what's going to happen, and it didn't really happen. You look at the dot plot, not a lot of confidence there, what have you. Even if you want to, some people want to throw that out with how inaccurate it can be, but nonetheless, even the Fed themselves largely were saying, tariffs are probably going to have an impact. We don't really know how much. It's going to lean towards the upside, but not a lot's changing.
Not a lot's changing, and if you take a look at all the predictions that the FOMC committee members are making in terms of what they think median GDP, what the median forecast for GDP is, for prices, all that good stuff, I got to tell you, Sam, that they're making predictions for the remainder of 2025, for 2026, for 2027, and then an even longer term forecast for this stuff. And listen, these are bright people. They have all the credentials, and you can imagine, very intellectual. But let's face it, no one can see into the future with that much crystal clarity. So really, once you get past 2025, I take most of the estimates with a grain of salt. But for the fact that struck me as sort of like, I don't like this terribly much, is all the median forecasts for gross domestic product, Sam, are pretty bleh.
Mm-hmm.
Sort of like 1.8. You get a steady diet of 1.8 or thereabouts. 1.8. That's a median estimate for 2025. That's about the median estimate for 2026, 2027. And the long-term economic outlook from what they showed on the dot plots today, summary of economic projections or predictions or whatever they call it, 1.8%, if I'm not mistaken, reading their report. And Sam, I'm going to tell you this, without mincing any words, that's not good enough.
Well, and that's what we've talked about for weeks, whether we're talking about the budget deficit, whether we're talking about rate cuts, tariffs, all of them. We've talked for a while about how we need to push for more growth. We need to push for something closer to 3 than a 1 handle.
Yes.
So
one handle doesn't cut it.
Just doesn't cut.
We're talking about, right now, we're forecasted to add about, I'm just going to round it up and say $20 trillion to the aggregate deficit over the next decade. If we're growing at 1.8%, Sam, we're going to wish it's only $20 trillion. Did I say billion originally? I think I did.
I know.
But you know what I'm talking about. But we're going to wish it was only $20 trillion. We've got 1.8%, and not forecasting a whole bunch of rate cuts in 2025 suggested they are really iffy about their inflation data.
I was going to say that the takeaway for the dot plots to me is less about a prediction of where they're going to be and more, I think it gives you some clarity into their thought process and kind of the pain points that will cause them to cut, right? Because if they're saying, hey, we're expecting unemployment to be a little higher than we previously expected, but we're still expecting less rate cuts, that kind of, to me, that's less of a prediction and more that, hey, okay, maybe they're willing to allow a little bit more pain on the unemployment front. So those are the kinds of takeaways that I get from the dot plot, and not even where the rates are going to be at the end of this year. I think even the next few meetings are up in the air.
Well, I think you're probably right. And my forecast has not changed for 2025. Started off the year by saying by the middle of the year, the Fed is going to have enough ammunition and enough data that if it wants to cut the overnight rate 3 or 4 times this calendar year in 2025, it will or could be able to do it. And nothing's changed in that forecast. Matter of fact, the economic data keeps on coming in a little bit softer, and then so does the inflation data.
Well, I think we are at a point now where I would say you're already right in that we probably have enough ammunition right now to be cutting rates. And again, I think that's less saying that we should. And, the administration and Trump is saying we should already have, 100 basis points of cuts. I think he said 100 to 200, or frankly, I think it depends on which time he's talking. But I think he's probably right in that sense that you could make an argument that we should be cutting rates right now. And if in a vacuum, if you didn't have tariffs, if you didn't have the administration pushing for rate cuts so much, that maybe we would have already been cutting rates. I mean, you can't back out what that would look like. But say there wasn't tariffs. Say tariffs weren't on the agenda or weren't already on, rather, and that the president himself was almost demanding rate cuts. You take those two out, do you think, there's probably a chance they would have cut today?
I would say you're really onto something, because if you take a look at the PC, the Personal Consumption Expenditure Price Deflator or Price Index, what is it, trailing 12 month? That might be 2.1%.
It's in the low twos.
Low two, I think it might be 2.1%. However, the forecast in the dot plots today was 3% for the remainder of the year. That's the median estimate for 3%. It's currently 2.1, 2.2%, low twos, as you said, which suggests to me, although there's not the word tariff in the entire report, with the dot plot report, there's no mention of the word tariff, but that does, seeing such a sharp increase from where we are, from reality to expectation, would suggest that something is out there, something's out there in the ether that's scaring the hell out of these people, and the only thing that I can think of would have to be tariffs.
Yeah.
So without a doubt, Sam, if we didn't have that threat of tariffs out there, I think that the median estimate for inflation this year would probably be about where it is, and that's low enough for me to start cutting rates when I'm staring a long-term GDP forecast of 1.8% in the face. If I have inflation down 2.12%, I'd like for it to be at 2.0, but that's low enough for me where I start cutting rates. However, because the president has gone out there and started a trade war with the remainder of the world, which could be inflationary, we're not seeing it in the data yet, could be inflationary, and because he has kind of tried to bully Jay Powell, which no one likes to be bullied, let alone the Fed, which is trying to be independent of the Treasury and Capitol Hill and 1600 Pennsylvania Avenue. Because those two things have happened, yeah, we didn't see a rate cut today. If we didn't have those two things happen, I don't think we'd be at 4.5 on the upper band of the Fed funds target. I think we'd already be at 4.
Yeah, and Powell even said that in his comments today, that part of that shift higher was the expectations that tariffs have that kind of higher, that push higher on prices, at least in the short run. And so that's undoubtedly been a part of that, and it's going to continue to impact what the Fed does. And you mentioned it, the independence is a big part of it.
Yeah.
There's, I think, a lot of question marks, but we also talked a while back about if the Fed starts cutting rates, that is not immediately flipping the switch from, gas to brakes,
No.
right? It's maybe going from foot on the floor of tightening to you have to slowly take your foot off the pedal before you start hitting the brakes, right? And that's what a few cuts would be. Is we'd still be kind of tight on policy if economic growth is in the 2% range, but it's softening it a little. And so I think there's already that justification, not for full on easing, not for cutting to 1%, but let's.
Oh, listen, I hope we never get back to a period of time where the Federal Reserve feels it's either desirable, expedient, whatever word you want to use, to take the overnight lending target back down to 25 basis points. I hope we never get there. That was foolishness, in my estimation. However, we didn't get the recession that we probably could have, would have, or should have, and we were able to grow paper assets significantly. We're also able to borrow a whole bunch of money at the federal level, which means we've got the debt problem that we currently have. So, getting down to that level of interest rates would just cause the knuckleheads on Capitol Hill to borrow even more and more money, which ultimately we'll have to contend with.
Yeah, and the CBOs even said that in their latest estimates, that talking about the one big beautiful bill, that it would actually, when they start adding in the expectation of higher interest rates for what it would cost us to borrow money, that it would actually raise that 20 trillion to be even higher.
It looks like everyone's anticipating the $20 trillion to be even higher. And shifting gears a little bit, we're going to talk about the FOMC here today. But in talking about, the budget deficit and what have you, I was having a conversation last night with Annie, my daughter, and Beth, my wife, out there. And we're talking about just how, federal budget cuts and all that stuff are causing a huge disruption in scientific research and what have you. I made a pretty, what I thought to be a pretty benign statement, but my ladies did not like it terribly much. Show you how much pull I've got in terms of politics in my house. And I said, everyone's all for balancing the budget until it comes to having to balance your budget, if you catch my drift. It's kind of like, hey, listen, I'm all for balancing the budget until all of a sudden it means, hey, Sam, guess what, man? That money you've been getting from Washington?
Yeah.
You're no longer getting it. And then all of a sudden,
say, whoa.
Hey, wait a second. Wait a second. Let's not get crazy here. And that's kind of what I think is going to be played out over and over again over the next decade, as unfortunately we're going to have to come to grips with some of this, and some of these programs are simply going to have to be trimmed in some form or fashion.
If you can't grow your way out of it.
Well, at 1.8%, that's what
Right.
we're forecasting.
So
we're not growing our way out of anything.
Right.
And so that 1.8% and that dot plot, if our best and brightest minds, our best economists in the entire country, arguably, or if they're thinking we're going to grow at 1.8%, we're not.
Yeah.
We're not going to do anything.
To me, that's the concern, right? That's a bigger concern. If the deficit's gonna be there, we are the
we can't. We're not paying that off.
And it's the whole capital account versus current account. Like, we are going to run budget deficits as a country that consumes so heavily.
Yes.
That's never going
until
to change.
We start producing. More than we consume. Yeah, we are going to be running deficits.
I'm just like the debt and the debt ceiling and the deficit. I have trouble caring about that as much as I do care about a country that has sluggish growth. And I just don't think that's the issue. It's been an issue for decades. If you would have postured yourself in 2010 with concerns about it, the economy is more dynamic now than it was in 2010. And it's still not an issue, right? I'm sure it'll become an issue at some point. Japan's way worse. But there's bigger problems that we have going on than the fact that we're spending more than we bring in.
Truth. Absolute truth.
We have to grow. If we don't,
we have to grow.
The collapse would start when we quit growing, not when. That comes to me. That comes before the bill. As they say, the bill comes due on our deficit.
Yes.
By a long shot. We are the reserve currency. There is almost endless demand for our treasury debt.
Almost.
I would argue there will always be demand for it.
There will always be demand for it, but maybe not at the interest rates in which where we currently are. And
maybe.
The Federal Reserve has been a huge chunk of that, but there will be demand for it as long as we are considered, as a country, a good bet. And historically, we've always upheld the rule of law. We've always been serious about strong individual property rights and what have you, and we've always grown pretty rapidly. At 1.8%, moving forward, maybe that still attracts capital, and it very well could be, not necessarily because 1.8% is wonderful economic growth. It could be awesome on a relative basis, as the remainder of the world is poised to grow significantly less, in my estimation.
Yeah, you're playing that relative game, and at the end of the day, it is the benchmark asset for every other asset pretty much on Earth.
Yeah. Okay, well, let's play this little game, again, veering even further away from the FOMC, but this is very much in keeping with, just overall talk about monetary policy and what the Fed should be doing. Next decade, 1.8%, if that's what the Fed thinks we're going to grow, is the UK going to grow faster?
Probably not.
Is France?
Probably not.
Is Germany?
Maybe, but probably not.
Is Italy?
I don't think so.
Japan?
Look, all these countries.
Yeah, I mean, you know what my point is.
Look, all these countries though rely on U.S. growth partially.
Yeah.
I mean, and maybe we've seen the switch flip a little bit in Germany. They're now going to go out and spend countless sums of money, and they've changed over the past year, and that's been part of the rebound we've seen in the.
Believe it when I see it.
Yeah, but that's these.
When Panther tanks start coming off the assembly
Yeah.
lines and going to the Eastern Front, I'll believe it
So
when I see it.
do we see some of these countries shift to those max deficit spending years that are somewhat predicted and has been the reasoning for the stock market growth that we've seen in Germany and some of these other developed countries?
Well, the thing is, what's painful is the thought process. Some of these European countries that are fiscally, in about the same shape we are spending nothing on their defense. And to try to get to 2%, which you're supposed to, but to get to 3% and even 5%, like our president has been demanding, although we're not at 5% either. But to even get to 2%, let alone 3%, money's got to come from somewhere, and the money's not already there. The money's just simply not there. So can you imagine how upside down their books are going to get?
Oh yeah, and that's I think the plan right now for Germany, or the expectation is if they actually follow through with
At the same time, while the Green Party is making sure that the German industrial machine doesn't have energy at a competitive rate. I don't know, man. 1.8% might be crappy here in the United States, but it might be very good on a relative basis. Even so, going back to the FOMC meeting, it seems like we've talked about international quite a bit recently. Going back to the FOMC meeting, I was kind of shocked today when I saw this statement. Really didn't change terribly much. People overparse that and mental gymnastics out the yin yang when they read the two statements, put them side by side. But when I saw the dot plots and heard the initial parts of Jay Powell's comments, I'm going, this feels like deja vu all over again. As you be kind of going back to what you said, this is the most important meeting ever and all that stuff. We always seem to say that, and every time after it's said and done, we always come back saying something along the lines of what Yogi Berra once said: "It's deja vu all over again." And I don't think anything's terribly different with today. The Fed didn't cut the overnight lending target. Dot plots essentially said what they said previously. Jay Powell was over the tapes pretty much reiterating what everyone secretly kind of knows. And the Fed funds futures market didn't do terribly much of anything before we started talking here. So why are we sitting around worrying about something that happens every 6 weeks? We get worked up in a lather about it, and at the end of it, nothing becomes of it, and then we would slowly work ourselves back up in a lather about it again.
Rinse and repeat. I mean, it'll happen again in 6 more weeks. It'll happen again next week with PCE, and we have these few. It seems like GDP is less important right now. It feels like that.
GDP is not. No one is talking about GDP.
It's inflation.
If you read, and we do all of our own research here at Oakworth, but if you read outside stuff, if you just go to the Wall Street Journal, you go anywhere. No one's talking about the crappy GDP report we had during the first quarter. I don't know anyone's talking about the second quarter GDP report.
Which
is going to be the reverse of the first quarter.
Oh my gosh, 3.5%, 3 to 4% GDP growth. Great.
But it's going to show slightly slower consumer expenditure, slightly slower private fixed investment, but we're going to see a massive improvement in our trade deficit, and that's what where all the growth go. No one's talking about that. They're talking about two things: inflation and the labor market, so we can find out what the Federal Reserve is going to do. And every 6 weeks, we sit around and listen to the Federal Reserve, and we have conversations like this.
It's trade war and the Fed, and those are kind of, like we've talked about, those are kind of tied in, but it seems like it's a singular issue that the market is focused on right now. It's several issues, but they're all tied together. What's happening with the labor market? What's happening with what's the Fed going to do, and do we get a serious trade war, or kind of just some back and forth tariffs and things are fine? And that's what, to me, the entire market is waiting for, looking for clarity on, is which of those two paths do we get? Do we get a soft landing still and not much of a trade war? Well, then the market probably keeps going up. But if we get the opposite, where things start to slow, the Fed's behind the 8 ball a little bit, and we get a significant trade war, that's a pretty bad outcome for the market.
Let me ask you this, and in terms of wars, which is more important to us right now? A trade war, global trade war, or war between the Israelis and the and Iran right now? Which is more important to the U.S. stock market?
I think it's a trade war. I think if we get a significant trade war, and I don't know if you would call where we currently are to be one, but if it goes to be a full-on trade war and tariffs escalate on both sides, I think that is what causes everything. That causes the labor market to weaken further. That causes a recession. That causes all the bad stuff that the market is fearing right now. War tends to not be that bad for markets. I mean, it's hard to predict, and it's incredibly difficult to trade. I think Kuwait in 1990 and 91 was a great example of being difficult to trade. But it's not necessarily bad for markets. The Israeli stock market was hitting all-time highs after the over the past year, 2 years.
I would agree with you. Absolutely agree with you. Right now, I mean, it's we've taken a look at when the Israelis started bombing Tehran last Friday.
Yeah, Thursday night, Friday.
And here we are, 5 days later? Has the stock market changed terribly much? Have interest rates changed terribly much? A little bit. But, everyone is horribly fearful about World War III or thereabouts over the weekend and how it escalated. And you could say it maybe has escalated a little bit, but it hasn't spread. And as a result, it's kind of fallen out of conversation here in the office. And so when it's fallen out of conversation here in the office, I mean, the only real thing that anyone's worried about right now with that seems to be, and perhaps we're just a little bit too focused on economics around here, is whether or not the Iranians eventually shut down the Strait of Hormuz. Mm-hmm. And that's it. And what will happen to oil prices? Even oil prices, yeah, they're up some, but not
like 90,
not what
$100 a barrel.
Not what people might have thought. And you take a look at everything else, like, kind of forgot about it pretty quickly. Come the close of trading on Monday, everyone was worried about the FOMC meeting, and as I think we've established here, is another kind of snooze fest. So, I mean, it's like, but you go back to it, which is more important right now? I would say it's very much getting this so-called trade war and tariff mess behind us. Let's put that in the rear view mirror. Let's focus on getting this bill out of the Senate, getting it passed, and getting that done, extending the 2017 tax credits, and then let's do something about the regulatory environment, and let's grow this bad boy. I mean, like far more than 1.8%. And obviously, I've said that over and over again. People listening to this are probably going to go to sleep at night hearing 1.8. I will tell you this, though, that truthfully, out of nothing else, out of the dot plots, that concerned me the most.